Right now, it is time to bring in Jim Lynch. It is time for Cover Your Assets. Jim is an independent voice on Wall Street, the economy, sports, Saudi Arabia, beheadings, choppings up, and more. And we welcome him in this morning. Good morning, Mr. Lynch.
Good morning. I just want to say that I'm here for you.
Well, that's good. That's good. We need people that are here for one another. All right. So, anyway, it is.
Hi, Jill.
Sorry?
He said hi.
Hi, Jill.
Hey, Jim.
Go ahead, Marshall. Sorry.
No, that's right.
I'm waiting.
I'm
I'm
waiting.
listening.
All right. So, well, there's so many pieces of pie that we can eat this morning. Why don't you start off, Jim?
Let's start off with some basic economic things.
Yay.
Kind of do a little point by point. Stock market got rocked last week, primarily because interest rates are going higher, something which we've talked about on and off over the last months and days and so forth. I expect rates to continue to rise because it's a natural thing that's happening. Interest rates were kept too low for too long, like 10 years. And the idea is the Federal Reserve is a disciplinarian in terms of keeping things straight. Money supply, not too much, not too little. Inflation, not too much, not too little. And so this is a normal occurrence. However, it happened after when people started realizing it and they started selling their funds and stocks. It was kind of natural because a lot of people have a lot of profits in the stock market. And this is one of the risks of the stock market, that people really have a lot to gain by selling at certain times. The second thing on the economic calendar is our budget deficit for the United States of America is, up 17% for the current administration's first fiscal year. This is due in part by the tremendous tax decrease given to corporations and an increase in spending, particularly on defense. We anticipate that the deficit is going to continue to rise because the tax cuts have been put in place for corporations, and that's not going to change anytime soon. They are permanent. The second thing is we do have a lot of needs in this country, and so that's not going to change. So the amount of bonds outstanding and to come to finance our debt is going to put pressure on rates, so rates are going higher. We said, I think, a month ago or more, and maybe a few times before that, if you are on the cusp of buying a new home or a condominium or something, you probably should act now because rates aren't going to go back to where they were. Goldman Sachs reporting good earnings, which will help the stock market today. I think the stock market will continue to be under the pressure of what's next in terms of the world economy. And bond prices, I do believe, will continue to go lower, yield higher. So it's a time for great caution, a time to prune your portfolio of stocks that have not acted well in this past big run. And the key is to find out from your advisor or your broker or your own research why that is, and is the potential pretty good. It's a very risky time, folks, as you know. In terms of these high-tech communicators, stocks that are basically in the field of giving us information via the Internet, I think they're going to continue to be vulnerable, starting with Facebook, because people are people don't trust giving their information as they used to trust, and that will impact earnings. Hats off and a fond farewell to Paul Allen, the co-founder of Microsoft, wonderful fella, made a ton of dough, invested like his pal Bill Gates philanthropically, and owned the Seattle Seahawk football team and the Portland Trailblazers. A great American and a great contributor to our society.
Can I?
Go ahead. Sorry.
No, I'm sorry. Just a quick bond question. Would you have people adjust their that ownership in any way?
Well, we've been an advocate for some time of avoiding maturities 5 years or longer. In fact, they go back to 2017, and then the winter of 18, where we've had posts telling people to sell 5-year government bonds and municipal bonds. And indeed, yields have gone up, prices down. I would continue that posture vis-a-vis the government market, particularly because the amount of financing ahead because of our deficit is huge. And I'm very, very concerned that our behavior internationally and our lack of character in the person leading the country, one of these days people are going to, rather international investors are going to say, I think we've had enough of the bravado and the America first baloney. America used to be the leader of the free world. Now it's the taker from the free world. So I'd avoid 5 years and longer. Now you have to look when you look at a bond, and you know if you bought the bond when yields were 5%, and it's getting closer to we'll say 8 years, and you bought it was a little older. You have to use common sense. If you're getting a good yield from your initial purchase, a good amount of income, then you don't sell it. You hold it through rough times. But if you've been buying the longer bonds in the last 2 years to increase your yield, I'd say sell it, take your loss, and go onward and upward. You know, there's no embarrassment, there's no shame in having a lot of cash in your portfolio when everybody else is saying, oh, you got to buy this, you got to buy that. You can look back to the time when we did have a fever, and I'm not saying we have a fever now, but we had a fever in 2000 in the dot-com bubble, and boy, they were down 75% in about 6 months. At that time, everybody just couldn't get their hands on enough things that said tech on them. And so you have to be just cautious and use your head and put a risk factor into any investment you're making. Can I afford to risk 20% of this capital as a barometer? And I say 20% because when you're down 20% in a lot of different investments, unless you're really very keen on knowing exactly what you're doing with the company, you probably have to sell that company because you've made a mistake. And there's no harm in making mistakes. The problem is in persisting in mistakes. I'll tell you a story. It's a long time ago. There's a company called Recognition Equipment, and a fellow in our office, he must have bought it at 20 or whatever. It was very bullish and this and that and the other thing. He got up to 100 and some odd from about 20, and then started downward and started downward and started downward. And I guess he ended up breaking even or losing money. You can't be greedy, and you can't be overly fearful. You've got to have a plan, and you got to know your risk tolerance.
And just what you just mentioned, cash, and there's no shame in cash. What do you typically just advise people in terms of cash? Which brings me to a totally different topic. Do you know how many people do not keep any cash around their house?
Do I know many people?
Do you know how many people? No, I always think, like, hey, if your power goes out, or if you have, it's been a while since the last power outage in New York, where people realized that their chargers didn't work and ATMs didn't work, but I think there's so little connection from a certain age group about how how you pay for things. Money, you don't need money.
Okay, you're making an excellent point. We might be beyond the pale now in correcting it.
Yeah, we probably
I see
are.
this with young people. I saw it like some time ago, actually. I was going in for a high-priced Starbucks coffee, and I was waiting in line. And there was this young woman. She bought, I don't know what she bought. It cost $2 or $3. And don't you know, she pulls out her ATM card. Now, we're talking about purchasing a $2 to $3 item. And she obviously didn't have the money in her jeans, or basically she was saying, I'm part of the digital economy, and I know it's very convenient, but I'm basically not even thinking about the risk if the system goes down. We've seen the system go down. We know that hacking is occurring from foreign powers. We know that we have natural disasters. And so the answer is you should have X dollars buried somewhere in your home for contingencies which are more apt to happen now than they were 20 and 30 years ago when we were not so ensconced in technology which can go awry. The other thing in terms of having money near at hand, you should always have some money in, shall we call, a savings bank type of situation, or just in your checking account, so that once again, if indeed the car goes out and you need to spend $5,000 because you need to go to work, you've got X amount of money in the checking account. Back to something you raised before you got into the cash. If you want a good investment, not a good investment, a good yield at the moment, something like a 2-year government bond, AAA backed at 2.85 yield. Now that's up, let's call it 130, 50 basis points in the last year or so. So short-term interest rates go higher as well as lower. But if you want to park cash, I'd park it in a 2-year. I wouldn't go 5, 10 years to pick up the extra yield, because I think we're coming into a situation where longer maturities are very, very vulnerable. There's a report out today that China has about $5 trillion in what we call special facility bonds, which are bonds that are issued by various authorities in China, which the government is not directly responsible for. There's an anticipation of X amount of those being allowed to default in the near term. You've got a tremendous amount of corporate junk bonds coming due in the next, in the 2019, 2024 area. Again, pressure on the bond market in terms of the need to refinance that. You've got a huge amount of governments to be done. Municipals are starting to pick up in terms of their issuance. It's kind of skinny. So we're coming to year end, and I keep a lot of powder dry in terms of investing. And there's nothing wrong with that, folks. You know, this idea, oh, you have to do this to do that. Well, there are times in the market where you just have to pause and say, does my risk tolerance overcome the need to grow this money like I'm being told I'm supposed to grow it? Life is for the living, not for the worrying. And so when you make investments, you should be certain that the money you're putting in, there's a margin of loss that you can take if it doesn't quite pan out without it making your life miserable.
Do people usually? I don't know how quickly people alter, just regular people alter or adjust their reallocate their portfolios. And I imagine that a lot of regular people are just in mutual funds that they rely on the various fund managers to adjust. I guess what I'm trying to say poorly is I don't know how attached people are really to who's doing what with their money.
All right, it's pretty simple, but it's somewhat difficult for a lot of people. They think they know what they're doing. They're lazy. They don't want to put in the work. If you've invested in anything, you have to monitor that. And it might be a mutual fund that you're in, and so, you have a manager. It doesn't matter if you have a manager. You've got to be checking on what is going on within the framework of the fund or of the stock purchase or the bond purchase. You get statements from brokers or from funds that shows you the net asset value of your assets. It shows you what things are worth, individual things. It's incumbent upon you once a month when you get that statement to take time off on a Saturday or the weekend, better said, and with your spouse or family, just go over it and say, what is going on? Gee, this looks great. This is that. This is this. And begin to question it. Begin to question what you should do next. And most of the time, if you made sound investments, you'll simply say, well, it's doing pretty well vis-a-vis the goals we've set up for it. And so we're going to continue to own it and monitor it. But if you have your hard-earned money, including in funds, folks, funds run into snafus as well as individual investors. BlackRock, the huge fund complex, got about $7 trillion under management. Larry Fink reported that people, because of fear, were getting out of their funds, and this was just around the time before people really focused on interest rates. And fear is something that must be put into play in terms of your investing. There's always fear that comes in and out of markets. It doesn't mean you've got to react, but it does mean you have to be cognizant of it and measure in whatever way you can measure the risk involved. You can't give in to fear, but you can't be stubborn and say, oh, well, it'll come back, or this. That's a surefire way to lose more money. Once you hear your consciousness saying, oh, well, that'll come back, that's the time to get out.
Good point.
Sorry to be so optimistic on this wonderful sunny day. Frost on the pumpkin here in New York.
Yeah, it's pretty chilly.
It's quite cold up there, huh?
Yes, it is. But it's. I'm not going to say it's optimistic / pessimistic. I'm going to say it's practical, and I think that the more connected, again, people are to the practicalities. You sort of alluded to it when you said there are people who don't trust Facebook. Don't trust that their information is going to be safe anymore. And talk about horses being long out of the barn. There's just because. I'm sure you will remember that, a few months ago I mentioned that Bank of America had replaced all of our cards because of a security breach, which they wouldn't tell us about. Well, it just happened again. And what they do is they just cancel the card. They send out new cards to everybody and expect that that you'll figure it out when you go to use your old card, and it doesn't work anymore. And there's just so much of that. That is the rule rather than the exception. And it's sort of time to take it back, I think. Well,
this makes your point. This underscores your point about having cash availability, and it underscores our point in terms of being responsible for what you're doing. And we've mentioned on the show countless times, we've chatted about the new technology, which is grand, it's great, it's fantastic. But everything has some kind of limitation, And we've got to be more cognizant, more aware of these things. And you mentioned it earlier in terms of a power outage. Now, if you look at what's happened here in this little world of ours here in the last couple of months, okay, we have Carolina, we have Florida, we have Alabama, we have Georgia. The thing is, France, in southwest France, they had floods. They haven't had a flood like that since 1891. This little town inundated, underwater almost. Now, we know something's going on, and let's not get into this. Is it going to change, according to the president? Well, he's not convinced of it.
We only have about a minute left here, Jim.
All right, well, this has been fun.
You could have gone on for another 30 seconds.
Okay. I just want to... No. It's been fun. I just wanted to acknowledge that. I'm glad Jill participated a little more today. And not that she doesn't participate all the time. I want to wish you a good week. It's going to be a little chilly. Enjoy it. Folks, I'll be telling you, and I know friends and this and that, these are tough times. Hold your head high. Pull up your socks. We'll get through it. I love you all. Have a good one. Bye-bye.
Okay, Jim. Thank you very much. Jim Lynch, and Cover Your Assets this morning here on Robert Hood Radio, robinhoodradio.com.